Hi everyone, Sue Talbot here, and I also have Wayne Washell with me here. And welcome to week 12 of our In Focus videos. So for those of you who don't know me, I'm a partner and portfolio manager here at Genis, and I have been with the firm since day one. And I've spent my entire career here, and I started off in back office and operations. And I think I've done almost every single job you can think of here at Genis. So I moved on to middle management, and then I got the opportunity to work with Leslie Cliff and her clients. And that's when I realized that I really enjoy working with clients and helping them with their portfolios. So here I am today, and I'm very fortunate to be working with a group of portfolio managers here at Genis who are very passionate about servicing our clients and making sure their financial goals are met. So I have the pleasure of interviewing Wayne this week. And so let's get started. So Wayne, today was a big update in the markets, but let's talk about that later. Let's talk about the big headline in the world, and that is the ongoing unrest and rallies that are happening in the U.S. And in fact, they're happening not in the U.S. but globally as well. The reason behind these protests is really important, but let's just talk about how the markets are reacting to these protests. And so obviously these are mass gatherings. Social distancing is not happening, although, people are wearing masks, but, not sure if they're actually wearing masks for health reasons or not. Things have been peaceful the last couple of days, but, there has been rioting and of both, small businesses and big businesses who have already been hit, by the pandemic. So why are the markets unconcerned and largely looking past these events? Should the markets be more concerned?
Well, I'll give you my take. If you look at history, you look at 1968, which was a very violent year. There were assassinations of U.S. leaders in that year. And look at 1992, during the Rodney King, it didn't really affect the market. So I think if there's any implications for the marketplace, it's going to be these mass rallies that might actually cause a bit of a boost in the pandemic, after the fact. And it could have a bit of an implication as well on the presidential race, I would say. It looks like Trump fell in the polls during his handling. He fell in the polls during this whole thing. Yeah. So that's the thing there. But I think the big news this week was there was just so much good news on the economic side. But
yeah. So today was an exciting day in the market. So it was a big update, and it's primarily due to the job reports that came out in both the U.S. and Canada. And I think analysts were expecting the unemployment rate to increase and not decrease. And so just talking about the markets, the S&P is up over 40% in US dollar terms from the March low. So Wayne, is this a V-shaped recovery that few predicted? Is it safe to go back in the water? Is it over?
Well, we've had a V-shaped recovery in certain stocks. The tech stocks, all the winners of the pandemic, the shut-in stocks that did well, technology, healthcare, they've had a V-shaped recovery. Some of the areas like financials and oil haven't had that quite yet, but they're improving. They've improved dramatically. It was a big week for financials, energy, and industrials. And the numbers as today were very positive. Supposed to be down minus 8 million, and they were up 2.5 million. A 10 million spread, huge. But that just capped a great week. There was good news coming out all week. The yield curve got steeper during the course of the week in terms of long bond yields went up, which is a good thing. And the value stocks rallied, small cap stock rallied. So the market saw this coming, I think. And there's been a lot of noise by economic and market commentators about this big disconnect between the market and the economy. I've been saying it from day one. This is a man-made, a government-made recession where they just turn the engines off, and then the economy falls, and they turn it back on. And we didn't know how the economy was going to respond to that. And it looks like it's responding okay, and we're getting a bit of a recovery here. And it's the market looks 6 to 9 months forward I'll say that again, into the future. The economic numbers now they're getting better, and they will get better, but the market's looking into next year already. And so it's looking way ahead of us, and it's been actually right in terms of what it's been saying in terms of how the recovery is taking so place. But there still are some issues out there in terms of solvencies for some of the Main Street, which has been hit very hard. And so we still have to wait, but we're so far so good sign so far.
Yeah, as they said, there's a big disconnect between Main Street and Wall Street. So let's talk a little bit about the group of stocks that have been really hit hard by the pandemic. And these are the airlines, the cruise ships, and the hotel stocks. And they seem to be staging a bit of a comeback. Carnival, Boeing, American Airlines, MGM Resorts are all up double digits during the past few weeks. And I recently saw a headline that said, are the losers now becoming the winners? So what do you make of this? And have we made any changes to our equity portfolios because of this?
Well, we've been actually, through the course of the past couple of weeks, we've been adding some more value-driven stocks, more economic sensitive stocks. But we've been focusing on the banks, oil stocks, and industrials. We haven't really stepped into pandemic losers, the big losers I would call, which these stocks are. And these stocks, they were probably off 70% at their bottom, maybe some even lower. They're still off. Most of these stocks are still off 40% from their February highs. So they're coming back. It's more of a dead cat bounce, as they call it. And they're due for a bounce because they really were beat up. But they still have a long ways to go. And there's still concerns about their business model going forward. And they're not really out of the water yet, I'd say, until there's some kind of solution to the pandemic, whether immunization or something. But they still have issues with their business models. It's not going to go away. They're still going to have profits impact for a couple of years, I would expect. But they are coming off the bottom as we get more visibility on the recovery here. They still have issues.
Yeah, it'll be interesting to see, especially what happens with the cruise lines. So we had our June asset mix meeting yesterday, and so this is where we look at our macro signals, and there's 30 signals and 6 different categories that we look at: monetary policy, the economy, inflation, risk, and others. So what did our signals tell us last month, and what trades will we be making in our client portfolios as a result?
Yeah. Well, the signals were positive this month in terms of risk, taking more risk. They simply reinforced the previous month. Our World to Cash signal, for example, got more positive versus previous month. So what we did, we were overweight equities in the first place going into this. So we did a bit of a shift on the equity side. We sold some dividend strategy and bought some more CanGlobe, more of a growthy mandate. We also spent some cash and put that into some of the spread product to corporate bonds. In Canada, we also bought some more of our global macro strategy in the US, which contains high yield and emerging market debt, corporate debt. So we're taking more risk on the bond side as we see more visibility and more positive issues coming forward in the economy.
Okay, so let's just switch gears now. Today is World Environment Day, so I just want to spend a little time and talk about our fossil-free and impact strategies. So about 40% of our clients are invested in this way, and these strategies look through companies through an ESG lens. So we look at environmental, social, and governance factors. So Wayne, what do you think the demand for ESG investing will look like in a post-COVID-19 world?
I think it's going to improve. It's going to be more demand for that. And I think coming from both the buyers of it and also the corporations, they're going to focus more on that going forward. Let me tell you why. There's ESG, environmental, social, governance. If you look at the E first, the environmental side, I think with the pandemic, it's making people more aware of what's going on in nature, and also a need to be more prepared for a potential pandemic or a climate change issue. And also, it also brought forward the issue of fossil fuels and how there's the pricing, the high cost producers are being priced out because people are going to consume less of them going forward because of less travel and everything else. So there's a risk aspect for fossil fuels, but also more of an awareness out there. So I think it's going to push demand for the environmental aspect of ESG. Also, with the social side, what's going on with the race riots right now, for example, is going to make that more more important going forward for corporations. Today I saw a number in terms of Nike. Now Nike's been out there, they've been actually using Black athletes to promote their products. But today they broke out numbers based on their number of minority employed, which was like 20%, which is way below the economy. So they have some explaining to do from that perspective, and they have to raise their game. If they're going to use that for marketing, you have to as well be aligned, within your corporation. So you're going to definitely see more of a focus on that on the social side going forward, I would say. You've seen it from CEOs all this week talking about what they're doing and how they're going to raise their game there. I think we all have to raise our game there.
Yeah.
And so I think it's going to become more important, and just the whole race thing plays right into the social side of ESG.
Yeah, I think there's going to be a lot of changes coming. So thanks, Wayne. We want to keep these short, so we'll end it here. But before we sign off, I just want to give a shout out to anybody out there that has kids or grandkids graduating in 2020. I personally, my oldest son graduated from university this year, and unfortunately we can't, participate in the grad ceremony. And I honestly think I'm more upset than he is about it. My youngest son graduated from high school in 2019, so he's not affected. So I just want to say congratulations to all the grads out there of 2020, and hopefully you'll have a chance to celebrate in person with them, friends and family at a later date. So thanks again for watching, everybody, and please call your portfolio manager if you have any questions. It's really important for us to keep these conversations going and to stay in touch. So have a great weekend, and thanks for watching, and we will have the dream team, Leslie and Wayne, back next week. So, thanks, everybody. Thanks, Wayne.
Bye-bye.